Uber reporting third quarter results. The company posting a loss of 68 cents a share. That was better than expectations, but still comes out to a loss of over $1 billion for the quarter. Uber also beat revenue of $3.8 billion. Joining us now to break down the company's results, Tom White, senior analyst at D.A. Davidson. Do you believe the forecast for 2021? Is that doable?
Look, I think it'll be very interesting to see whether or not consensus estimates sort of honor this target. It's a very aggressive target. The consensus heading into last night had them losing $1.3 billion in 2021. Now the company's saying EBITDA profitable, not just for the quarter exiting 2021, but for the full year. And they didn't really give a lot of color on the call about exactly how they're going to get there or what the business will sort of look like. For example, that target doesn't necessarily mean that or predicate that Eats has to be profitable or even break even, for example.
So if you factor out Eats and the other businesses, is the ride-hailing business at Uber profitable right now on EBITDA?
It looks to be EBITDA positive. Now, last night they said that their rides EBITDA for the quarter was EBITDA margin was 22%, which sounds great. They talk about some markets having an EBITDA margin of 60% or nearly 60% for rides. Now, that does exclude about $620 million in unallocated G&A and platform R&D, which is a pretty big number for the quarter, and they sort of set that aside. But they're just sort of covering that unallocated G&A, so it looks to be
so you like Lyft more, but Lyft is not profitable on it's just ride hailing at Lyft, and they don't expect profitability on an EBITDA basis till 2021. Is that correct? So they're behind Uber on profitability for just the ride hailing.
So Lyft has said, exiting 2021, they expect to be EBITDA profitable.
Uber's already there? Really? Except for the $600 million.
Yeah, exactly. So the EBITDA definition maybe isn't apples to apples, and I think the market generally expects that Lyft is probably being a bit conservative with that timeline and can actually beat it. Look, I mean, the reason we prefer Lyft is just visibility, plain and simple. If we had a super long-term time horizon, say 3 to 5 years, we think maybe Uber's interesting for folks with that type of time horizon. But over the next 12 to 18 months, Uber's just fighting a lot of battles on a lot of fronts, particularly in Eats, competing with companies that are still private, flush with VC money, and Uber's, having to react and respond to some pretty aggressive promotional and sort of competitive activity.
Would it make more sense for Uber to potentially spin this off and then just kind of focus on the core business and get a better valuation?
I don't think spinning off would be the right strategy. I think over time, the fact that you actually have ride sharing and Eats on the same platform could be a real competitive differentiator versus some of the pure play players in online food delivery. You just will have more drivers in your marketplace because drivers know that they can go to Uber because if they can't find a ride sharing ride at a certain time of day, they might be able to make some money delivering Eats. Same thing on the consumer side. Uber's now integrated both products into the same consumer-facing app, which hopefully should drive more sort of habitual day-in, day-out usage for people and maybe drive more loyalty. So I don't think a spin-out's the right answer. But Uber did talk about last night how they're going to be, I think, more decisive in how they assess certain online food delivery markets and maybe exit them more quickly than they otherwise would have. They just exited South Korea, for example.
So meaning that they're going to focus on places where they can get to profitability, that's a message that's coming through loud and clear, that the investment tenor has changed. People want to see this path to profitability?
I think the timeline that they're willing to look at for assessing whether they can be number one or number two in a market is condensed.
Does it also mean that they will be less aggressive with trying to keep up with competition in the markets they decide to stay with in terms of price cutting or other things? Or do you think that if they stay in a market, they have to, do what the airlines used to do, is be as dumb as your worst competitor? Right?
Yeah, so far the company line has been that in those markets where they see a clear path to number one or number two, they're going to respond. And so, again, that kind of is probably good for the long-term health of the business, but makes forecasting...
Did the discounting at both companies start to diminish? I mean, that's the other race to the bottom as your dumbest competitor. That's gotten a little better, right?
Certainly in the U.S., certainly in ride sharing.
In ride sharing, okay.